Welcome to Part D of our six-part series on balance of payments and exchange rate regimes. In Part C, we built the architecture, the three regime types, and the trilemma. Now we go deeper into how central banks actually defend their currency, how speculative attacks unfold, and how currency crises develop. We will see real historical examples: Britain in 1992, Mexico in 1994, Thailand in 1997, Argentina in 2001. We will understand the role of foreign exchange reserves and why running out of them is catastrophic. By the end, you will understand why fixed exchange rate regimes are so hard to defend in a world of free capital flows. Let us begin. Section 1. How intervention works. Central banks defend exchange rates through direct market intervention. To prevent the currency from depreciating, the central bank sells foreign currency reserves and buys domestic currency. This removes domestic currency from circulation and adds foreign currency to the central bank's balance sheet, though depleted. To prevent appreciation, the opposite. The central bank buys foreign currency and sells domestic currency. This adds domestic currency to circulation and increases reserves. Most intervention happens through the spot market, with central banks trading directly with commercial banks. The mechanics are simple. The consequences are huge. Section 2. Sterilization. When a central bank intervenes, it changes the money supply. Selling foreign reserves shrinks the money supply. Buying foreign reserves expands it. If the central bank wants to keep money supply unchanged, it can sterilize the intervention. After selling foreign reserves, the central bank buys back domestic bonds to put the cash back in the economy. The net effect on money supply is zero. Sterilization gives central banks more control. But it cannot solve the fundamental problem if a peg is fundamentally misaligned with economic reality. Sterilization can buy time. It cannot buy salvation. Section 3. The mechanics of a speculative attack. When markets believe a peg is unsustainable, they attack. Speculators borrow domestic currency, exchange it for foreign currency at the central bank's pegged rate, and wait for the inevitable devaluation. When the central bank runs out of reserves and is forced to devalue, the speculators repay their domestic currency loan with the foreign currency they hold, now worth more in domestic terms. They have just made a fortune. George Soros famously did this to the British pound in 1992 and made over $1 billion. The mechanics are simple. The damage to the targeted economy can be devastating. Section 4. Britain 1992, Black Wednesday. The classic case. The pound was pegged within the European exchange rate mechanism at an overvalued level. Britain's high inflation made the peg increasingly hard to sustain. Markets attacked. The Bank of England raised interest rates dramatically, first to 12%, then to 15% in a single day. It bought pounds, depleting its dollar reserves. By the end of the day, it had spent over $27 billion defending the rate. It failed. By the next morning, Britain was forced to suspend the peg. The pound depreciated 15%. The episode permanently damaged faith in fixed exchange rates within Europe. Section 5. The Asian Crisis 1997. The most famous emerging market currency crisis. Thailand's baht was pegged to the dollar at 25 baht per dollar. Years of borrowing in dollars and lending in baht created a fragile situation. When confidence collapsed in summer 1997, the central bank ran out of reserves within weeks. The peg broke. The baht crashed to 43 per dollar within months, a 56% collapse. The crisis spread to Indonesia, South Korea, and the Philippines. Stock markets across Asia plummeted. The IMF intervened with massive emergency loans. The episode demonstrated how fast a currency crisis can spread. Section 6. The cost of reserves. To defend a fixed exchange rate, a central bank must hold large foreign currency reserves. These reserves typically earn low yields, about the interest rate on U.S. Treasury bills. The central bank pays much higher rates on the domestic currency liabilities it issued to fund these reserves. The difference, sometimes 1 or 2 percentage points per year, multiplied by the size of reserves, can amount to billions of dollars annually. This is the carry cost of reserves. For an emerging market country with reserves of $200 billion, the annual carry cost can easily exceed $5 billion. This is the price paid for currency stability under a fixed regime. Section 7. Why fixed regimes are so hard. The fundamental problem is that fixed exchange rates require the central bank to subordinate domestic monetary policy to the defense of the rate. When domestic economic conditions call for low interest rates to stimulate growth, but defense of the peg requires high rates, the central bank faces an impossible choice. It can either let the peg collapse and lose credibility forever, or it can wreck the domestic economy by maintaining high rates. Modern emerging markets that have tried to maintain fixed rates have almost all eventually broken. The pressure builds. The exit is always painful. Section 8. Modern intervention practices. Most modern central banks have learned the lessons. They do not commit to specific exchange rate levels. They allow the rate to float. They intervene only to smooth excessive volatility or to slow appreciations that hurt exporters. This is the managed float approach. The Bank of Israel has been a major practitioner since 2008. Reserves grew from $30 billion to over $200 billion. The intervention has been substantial but never committed to a specific level. This combines the policy flexibility of floating regimes with the operational tool of intervention. Most modern emerging markets now operate this way. Conclusion. We have seen how central banks defend their currencies. We have understood the mechanics of intervention and sterilization. We have walked through speculative attacks. We have examined historical crises. Britain 1992, Asia 1997. We have understood why fixed regimes are so hard to defend in modern markets. And we have seen the modern alternative, managed floats. In part, we move to the real exchange rate, the inflation-adjusted measure that actually drives competitiveness. If you found this useful, please share. And subscribe to Macroeconomics with Michael for parts E and F.